Hello everyone, my name is John Locke and I'd like to welcome you to the winning trade, but first the required disclaimer. This presentation is given for educational purposes only. We are not broker-dealers or financial advisors. We're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and make sure you are aware of all your risks prior to placing any trades. Also note that we are using hypothetical computer simulated trades and the results in the presentation. They are believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Locke in Your Success LLC, and myself and my team are here to help traders win in the market and in life as well. And today I am here to guide you into the realm of high probability trading. Now in a moment we're going to be going over the winning trade, but before we do, let me quickly explain what we mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction, meaning that we can often make money whether the price goes up, down, or sideways. Now, this doesn't mean we're going to win all the time, but it does mean that the probabilities of us winning tend to be much higher than they would be otherwise. Now, when you find that you want more information as you're following along, simply contact us at lockeinyoursuccess.com or ask a question in the comments on this video, and we can direct you to where you can find more information. The Super Bowl is a trading strategy that we do either on the SPX or the Russell 2000. The example is going to be in the SPX. It's going to require a minimum of around $1,000 of capital, and it has a profit target of 100%, as well as a maximum loss of 100%. Now, this being the case, it means you would not want to trade this with your full account size, as one might do with some other types of strategies we've discussed in the past. With this trade, we really need to limit the position size and keep it smaller. And I would recommend a minimum account size of $10,000 if you were going to trade a $1,000 planned capital trade. All right, let's look at the guideline summary. So we're going to start this position when the monthly cycle is 65 days to expiration. And yes, you can use weekly positions if you'd like. You just use it in the same way. But for the example, we're going to do monthly expiration cycle. That is 65 days to expiration. We're going to enter a bullish vertical in a manner where the total potential profit and the total loss are about equal. Now, there are going to be some variations in the full guidelines, but for now, this is all you really need to know. And once we enter the trade, we essentially do nothing until the next monthly cycle is 65 days to expiration, at which point we are going to enter the next trade, or trade 2. So this is going to be an overlapping trade. We'll have 2 on at one time. And when we enter trade 2, we're going to do a check on the original trade. And if that trade is up money at all, we're going to exit the first trade. If that first trade is down money, we're going to monitor that first trade daily, once a day, near the end of the day, and see if it is up money. If the trade does become profitable at any point, we will exit the trade at that checkpoint time. Otherwise, we're going to allow the trade to expire. Now, this is what the entry of the position looks like. Basically, what we have here is we have the index price along the bottom. We have our profit and loss on the right side here. We have the solid blue line, which is what this trade is worth at expiration if we were to allow it to expire. We have the curved red and green line, which gives us a profit and loss estimation as of today, as well as an estimation of the profit and loss when the price is at any particular price point today. As time goes by, this curved line moves more and more into the shape of the blue line. Therefore, when we look at this, the asset price essentially has to go up in order for this strategy to win, meaning that this position certainly does not look like a high probability trading strategy. And in reality, we may not even consider this an income trade, as we start out negative theta, which means if the price doesn't move, this is actually losing value every day. And if you look at the theoretical probability of this trade actually winning, it's only about 40%, unlike our other strategies, which are up in the 75 to 95% range. But as you'll see, in actuality, this trade wins much more than what the theoretical probabilities would lead you to believe. So let's look at the statistics of this strategy. These are the back-tested historical statistics on this strategy since January 2011 expiration until today. During that period, we had a total trades of 109. We won 86% of those trades, meaning this trading strategy during that period had an 86% win rate. We had a maximum consecutive wins of 31 wins in a row, a maximum consecutive loss of 3 losses in a row. Our average loss is 2.7 times our average gain, which can be a bit of a warning sign. In other words, with our strategies, we don't want our losses to be too much more than our wins, but 2.7 times is reasonable. The other caution here that we have with the strategy is the trade size must be small, and I would say 1/10 or less of your actual account size to maintain a reasonable risk management, which I think we mentioned a little bit earlier. As far as how the Super Bowl did this year, this is one of the trading strategies that we cover in our Go membership, and this is what we had. In January, we had a loss of 100%. We had a 19% gain in February, 76% gain in March, 47 April, 58 in May, 81 in June, 4% in July, 59% in August, break even in September, a 57% gain in October, 13% gain in November, 51.1% gain in December, giving us a trade for trade gain on $1,000 planned capital of 367.9%, which sounds fantastic, and it is fantastic, especially in a year where we had a lot of big down moves and a lot of big up moves. But we do have to correct this if we're looking at account size. And like I said, these are more or less $1,000 planned capital trades, and we're doing that in a $10,000 account. If you make corrections for that, that's an actual return on an account size, if you were doing it in that manner, of about 36.79%, which is, again, still fantastic. But this is why I love this strategy. It's easy, it's simple, and has a nice high win rate and really good returns historically. So let's look at the trade. It is now Wednesday, October 16th. Our options for our December expiration are 65 days to expiration. It's time to enter. And what I'm trying to do when I enter this is I'm trying to get about $1,000 risk and about $1,000 reward. Historically, we can usually achieve that. And we usually achieve that by going somewhere between having our long strike about at the money to maybe 10 points or so over the money. Recently, in the marketplace, the implied volatility skew, for those of you who know what that is, has been a little bit unusual. And if you trade these normally, you probably realize that by now. And what that means is in this particular environment, we're not getting 1,000 and 1,000. And even if I took this and I move this spread further away, we're still not getting that. And I'm only going to allow this long strike really to get around 10 points over our asset price. So that being the case, I'm going to accept an looks like about $837 reward for about $1,150 or so risk. We call this a $1,000 planned capital trade. Our returns are based on $1,000 planned capital. The reality is we have $10,000 in the account, so that exact number doesn't really matter very much. But that's how we're figuring our returns. Also note we'll have overlapping trades, but again, we have a $10,000 account. If we have $2,400 into trades, which would be more than the maximum we would ever get, we can handle that with our $10,000 account without a problem. So this is our entry position. So what I'd like to do first is to kind of show you where November is, because if you remember, these are overlapping trades, and I do have a November trade on. So we entered November back in, if I look at my T-log, back on the 11th of September. We've been in this for about 30 days or so, and we're not profitable. So a lot of the time we're going to come in here, we're going to enter our December trade, we'll look at our November trade, it'll be profitable, we'll just close it. In this case, it's not profitable. So what I'm going to do here is I'm just going to stay in this, and I'm just going to monitor this once a day, which is really the most active you need to be in this strategy. And in this particular expiration cycle, the market's been teasing us a lot, where we're just down a little bit of money. We keep getting these up moves, but we're not getting profitable. And we go, and here's the 25th, and we're almost profitable. And finally, let me ignore today's trades and go back to November. Finally, on the 25th of October, finally this turns profitable. We're up $138. Not a great return, but we don't really want to keep the risk on both trades any longer than we have to. So we close this down and we take a small gain for November. Meanwhile, December is here, and we're not doing anything with December. I don't recommend watching it. I don't recommend doing anything, just waiting until it's time to enter our January trade. Here we are on the 13th of November. It's time to enter our January trade because it's 65 days to expiration. This is profitable, and it's up $513, which is about 50% of our planned capital. So we're going to take this trade, we're going to close it, and of course we're going to open our January trade. And this trade is actually closed already at a profit. So if we were to move this to December 18th, this is what our January position looks like. It's up $593. It's time to enter our February trade. So what we're going to do is close the January trade here, and we would commit that, and then we would go into February and open our February trade in exactly the same manner as we opened the other two. And that is the Super Bowl. This episode's winning trade. If you like what you see, I encourage you to join us and discover how you too can follow along with this and many other great strategies as they unfold during our weekly Options Trading for Income webinars, and where you can also learn about our upcoming winning trade presentations and our trading success blueprint. And perhaps best of all, you can get information about our free Trading Performance podcast, where you can learn to become a much, much more effective trader regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on the video below so we can get those answered for you. And we would also encourage you to come on over to thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of other fantastic bonus information on how to profit through income trading. And please remember to subscribe to our YouTube channel and comment on our YouTube channel, where I can personally answer any of the questions you may have. Thank you, and we'll see you on the next Winning Trade.